Hello, hello. Good morning, good afternoon, and good evening. Welcome to episode 60, Fun Flow. This is Mark Yu,
Bobby Santos.
and welcome to our latest episode. So, for those who are not aware or first time listeners, me and Wawi are both working as a healthcare provider here in USA. We have the same passion and interest in investing our hard earned money in the stock market. So, we try to record at least once a week. We are not registered financial advisors, but we tend to share whatever we've found interesting in the stock market during the course of the week and share it to whoever is interested. So, on a weekly basis, we tackle the sentiments of the stock market. So, first of all, we're going to dive into the American Association of Individual Investors. This is free information. You could go to their website. So, for this week, as of October 26th, uh, there are now more bullish investors, up from 22.6 to 26.6, but it's still way below the historical average for sure. Bearish investors have declined for a little bit from 56.2, they're down to 45.7. Some of the bearish investors have jumped on the neutral camp, up 21.2% to 27.7%. So a lot more investors on the bullish camp for the past 5 days at least. Next would be the sentiments, fear and greed index. So for this week, as of previous close as of today, today is by the way, October 28th, Friday. So we are at 61. So we're now in a greed territory, believe it or not, Wowie. So, in such a short period of time. If I'm not mistaken, yesterday was a huge drop in tech industry, Nasdaq, and the tech sector because of the Meta earnings report that disappointed a lot of investors. Are you a Facebook or Meta platforms investor as well, Wawi?
Not directly, but through an index fund.
Mm.
Yeah, I think yesterday also was a reflection of weaker earnings from Apple and Amazon.
Yes, we basically have a lot of big tech companies, over $1 trillion worth, reporting their earnings. We're gonna tackle that in a second. How they grew their businesses despite fears of recession or already. I think we just came out also with the GDP, the gross domestic product, which take into account the nation's growth rate. So we registered positive number, right, Wawi?
Yeah, I think it's about 2 point something percent. I can't
Mhm.
remember. I just saw that number this morning. Um,
I think it surprised a lot of bearish investors out there. So for two consecutive quarters, the first quarter and second quarter of this year, the United States as a nation registered slowdown, negative growth rate. And then you're right, Wawi, for the third quarter, we registered 2.6%, better than expected as growth turns positive. So this is good news for bullish investors, for people who think that the United States will bounce back strongly from the recent inflation scare, which, by the
mhm.
way, the Federal Reserve is not done addressing. They're still hiking up rates. They're still jacking up rates, and I think they're expected to deliver another 0.75 rate hike on December 2nd. Right, Wawi?
Yeah, that's right, Mark. And I think that's gonna help with the money supply. Because if your money supply is exceeding your GDP, then there's a problem, and that goes in line with Cassandra's prediction.
Mm-hmm. Yes.
That's his thesis on that.
Yep.
Is if the money supply is overrunning the GDP, then we're in trouble for a deep recession.
Right. Cassandra, for those who are not aware, is another pen name by one of the Wall Street legends, Dr. Michael Burry, who predicted the real estate market crash about more than a decade ago. So
Mhm.
whatever words he releases, people definitely listen to it. Including yours truly, Wowie and me, myself. So looking at some, referring to the Fed, So since they've been jacking up rates, the financial conditions have risen. Actually, since last year, July. So they jacked up the rates, I think, first quarter of this year around March. But this chart right here is quite indicative. The bottom was set on July of last year, and financial conditions have tightened among all investors and consumers nationwide. So expect this to return to neutral sooner or later as the Federal Reserve tries to tighten the money flow, resulting in less, uh, less risk being taken among investors and business people, resulting in a slowdown and hopefully address the rampant inflation that's been happening. So this is the extreme greed and extreme fear index. So despite the on upcoming Fed rate hikes, investors seem not to panic anymore. By the looks of it, we've seen like a bottom back in September 30 in terms of being extremely fearful about the market. And now we're back in greed territory. The market momentum chart indicates that we're close to breaking that 125-day moving average, which just means that people are now getting a little bit more bullish, as indicated also by our previous sentiment, the AAII sentiment. The stock price strength is also trending up. How many stocks? This reflects how many stocks are doing well versus those that are struggling. So the number of stocks that are increasing now or recovering are increasing as the week goes on, despite the sell-off in tech, which we're going to tackle in a second. The stock price breadth also is bouncing back up. The put and call options as well is trending down. This is unique because all this time so far this year, me and Wawi have been tracking down these options trade. And although we do not trade them personally, we track them down to see how the sentiment is on the stock market. The higher this ratio is, the bearish, or more people thinking that the stock market will fall. But it's slowly trending down since September 30. September
Yeah,
28 on this one.
definitely back into equities for the time being, but
Yep.
we're still on a volatility trend, so we
Mhm.
don't know for sure where we're headed. Everything is still hinging on Fed movement.
Mhm. Speak. Yep.
Yeah, it's quite looking at the macro, looks like China is still on lockdown, and the war in Ukraine and Russia is somewhat quiet for the time being.
Mhm. Yeah, it's been silent, and Russia came out that stating that they probably won't be using nuclear weapons as feared.
That's good.
Speaking of volatility, volatility is down as well. It's down its 50-day moving average, so it's definitely trending on a downtrend from October 11. Safe haven. All right, we're gonna skip that.
Mhm.
For the group performance, we're seeing on a weekly basis for 1 week, real estate is the best performer, 6.44%.
As well as financials.
Financials up 5.72%. This is good news because we've been seeing a lot of sell-off in tech. So if you're widely exposed to tech, as yours truly, you probably won't uh, have felt this type of strong gains. But interestingly, there's only one sector down in the red, and that's communication services. And that includes, I believe, Facebook. So Facebook on Thursday dropped like more than 20%, erasing a lot of tens of billions of dollars in value along the way. For the past 4 weeks, past month, the strongest performing sector is no other than energy.
Energy.
Looks like energy is regaining its composure. So since the start of the year until at least around summertime, energy has been the best performing sector. So for the past month, looks like it's reclaiming that throne. It's up 18% as a group, followed by industrials. Actually, while we in this chart and this graph, only one sector is on the red, consumer cyclical, while all other um, industry are in the green, which is interesting. Could this be the bounce or another dead cat bounce?
I hate to predict, but it could be a dead cat bounce.
Oh, and then
Uh,
for
well, I would just like to say it's still we're still in very volatile times, we unpredictable times.
right,
So there's still a lot of risk. I think a lot of the risk has already been priced in, and we're just looking at near-term stability. Um, the market investors are definitely more bullish now, but still cautious in my opinion
right. And if we're
overall.
gonna look at the year to date, since it's January 1st of this year, only one sector is in the green, and that's energy, up 43%. All the rest are in the red. So not a good performance after all among the stock market. So this is an art snippet that we got from Financial Times that was just published. U.S. stocks closed higher for second straight week, despite big tech bruises. Apple shares have biggest one-day gain in over 2 years, helping to offset Amazon's decline. So this is a Bloomberg chart, back-to-back gains. Average stock has two big up weeks, something not seen since the pandemic lockdown. So this could be a good sign when everything starts skyrocketing down from the lockdown days to at least the end of last year. So definitely
Definitely a
getting
good.
bullish.
Yep, definitely getting bullish.
Some good omen. It says here another chart from Bloomberg. So this is in reference to an average stock compared to the Nasdaq. So tech. This is average stock versus tech companies in average. So average stock beats Nasdaq by most since January in this week. So definitely all other stocks are now beating the big tech companies. So this is just a price reaction look compared to its year to date performance. So I think it's better to split the performance here. So I have so definitely before we go into the specific tech companies here, we have the volatility for the past week is down nearly 15%. So which is interesting. So I think there's some technical backing of the recent uptrend, and we're gonna find out in a second if this is supported by fund flows as well, as our title indicates. So the volatility in the Nasdaq as well is down nearly 12%. This is despite the sell-off. So I could tell already there's a divergence between Nasdaq and S&P 500 just because of the sell-off. So here we go. So this was just published this morning by Reuters in terms of inflows. So global equity funds receive inflows for the first time in 10 weeks. So some positive news here, as what we have shared to our private messenger group. So global stock funds attracted money inflows in the week ended October 26, bolstered by expectations that the Federal Reserve would slow its pace of rate hikes to counter the economic slowdown. So investors bought net $7.8 billion in stocks last week after ditching them in the previous 9 weeks. So some good sign. There's some fund flows coming in comparison to continuous sell-off for the past 2-3 months, right, Wawi?
Yeah, that's correct. And because of the inflationary environment, the industrial sector is benefiting from it.
Mhm.
As you can see, they're all tracking the Dow Jones right now, and that's because the Dow Jones, give you the signal of when the rates are high. Usually, these industrial companies are doing better than your tech companies.
Right.
But another thing on my radar is um, short-term lending has also increased
Mhm.
for a lot of
Like the
these
credit
companies.
card.
Um, mostly for corporate, for companies. They're starting to uh, get more. They're borrowing more money, and sometimes from non-financial sources.
Mhm.
So, but 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 just know they're all trying to fund their corporations,
Yep.
and they're
To
looking at different sources.
finance their operations. But it's better definitely to see a big company generating cash flow, which we're gonna see in a little bit among the big tech companies. So just breezing through the fund flows. So a lot of money still went to the money market, meaning some investors are not decided to whether park it in the stocks or park it in bonds. There's still continuous selling in the bond market globally. Also in emerging markets, both bonds and stocks experience outflows globally. So only in the US we've seen some global, sorry. Only in Not only in the US, globally stock market fund flows are positive, except for emerging markets. So globally except emerging markets. So now we're gonna take a look at some specific stocks. So Meta Platforms or Facebook. You can see here for the past 5 days, it's down 22%. It's below $100 a share. It's still at around $266 billion worth. It's still a lot of money, but at one point, believe it or not, this was a $1 trillion company. So it has already lost nearly $800 billion in value. Since the start of the year, Facebook or Meta platforms have lost 70% of value. So it will require them to more than triple their price from here to get to break even. So 300 you're looking at 300% performance just to break even. So a lot of disappointing results from Meta platforms by led by its founder Zuckerberg, which is now still focused on bringing people into the metaverse or making them wear goggles or eyeglasses at the end of the day when you're tired coming from work, putting on
Mhm.
goggles and live another life somewhere else. So I don't know if it's really attainable, it's achievable at this point in time, but it's quite a huge jump from what we're seeing.
Yeah, it's
Which,
still a very young technology to be in, and there's not a lot of takers on that new technology. They're actually losing, I think, close to $9 billion, if not more, on that metaverse
mm-hmm.
play.
Yeah, so they Meta Platforms misses earnings estimates as well as revenue they beat. So if we're gonna take a look at their press release, they're still gaining a lot of cash. I mean, their active users have increased, believe it or not, 3% year over year to 1.98 billion. Their monthly active users are increased 2% too to 2.96 billion. So it's not about having difficulty gaining users, but it's more of their execution. Their ad revenue actually declined 4% just because of the dollar strength. But if not for the dollar, it's a 2% increase. Meanwhile, their costs have increased remarkably, nearly 20% to 22 billion, affecting their cash flow. So we're just going to look at their bottom line here. 3 months ended recently. Bottom line is 4.30 or $4.4 billion compared to 9.2 billion last year. And if we're going to take a look at their cash, they're still cash rich. 27 plus 13 is what? $40 billion in cash, while having at least nearly 10, 12 billion in debt. So Facebook is definitely still on the cash flow side, despite their price looking like a bankrupt stock already. So a lot of investors are giving up on this stock. So I'm not really recommending a buy here, but I'm definitely invested in this company and still holding. So let's see if whether it could rise 300% from here, which
Mhm.
is close to impossible in the
Well,
remaining couple months of the year.
when we have a pivot, these tech companies would, you would expect a big growth with this down pressured tech companies. So you're maybe correct. 3x may just be a minimum, in my opinion, once we reach neutral
Mhm.
for
Uh,
tech
we'll
companies.
we'll see. Maybe it'll happen when Zuckerberg finally decides that the metaverse, changing of the name to Meta platforms and engaging in a bunch of like headgear stuff is not really the future.
Mhm.
Next is the Amazon. So Amazon also suffered a big drop after its earnings report. It dropped 12%, big time, but it bounced back um, during the course of today. But regardless, for the past 5 days, Amazon is down nearly 14%. It's still at $1 trillion valuation. So let's just take a look at its report here. So they actually beat their earnings and they missed their revenue expectations. If we're gonna pull up their report, what I noticed with Amazon is they're doing good business with their operations here in the US, including their web services. Their main issue is their international business. It's been
Yes.
generating more losses to the company, despite racking up billions in dollars of revenue.
Well, you have
So,
to go back to the strength of the US dollar.
mhm,
For any investment outside the US, they have to um, like look at you know, the impact of a strong US dollar.
true. That definitely affects them as well. So for the bottom line, Amazon registered $2.9 billion in its recent quarter compared to 3.15 or 3.16 billion dollars. Not much difference if we're gonna compare it year over year. So this is what I was referring to. Net sales in North America, it grew by nearly $13 billion for the company. But still, despite that, operating expenses grew almost at the same pace, looks like. So it gave them at least 412 million loss compared to 880 million gains last year. The international sales, it actually dipped from 29.1 to 27.7 billion. And then it registered more losses, probably more likely because of the stronger dollar. From 911 million loss last year, it went up to 2.5 billion in losses. So the only saving grace for Amazon is its web services, as ever. It's always been reliable. From 16.1 billion in sales, it's now 20. It breached the 20 billion mark. 20.5 billion in sales and operating income of 5.4 billion compared to 4.9 billion last year. So, in terms of its cash, if you're going to add 59.8 billion plus 36, so they have nearly $96 billion in cash compared to their long-term debt of 48.7. Well, we're going to add the leasing liabilities here. Over $100 billion of debt. But this company is definitely generating steady cash flow. Free
Mhm.
cash flow. Yep. Free cash flow for the recent quarter is around $2.5 billion. Or trading 12 months, $2.5 billion. No. Sorry about that. We're looking at 2021. But regardless, it'll still be generating free cash flow, in my opinion. So we're done with Amazon, another underperforming stock. Next would be Apple. So Apple just notched its best 2 days for the past couple of years. Definitely bringing the S&P 500 up on average. For the past week, it's up 5.7% to $155 a share. Its market capitalization as a company is $2.5 trillion, the largest company in the world. So it beats its earnings and revenue expectations. Pretty good performance, strong performance by Apple. So we're going to pull up their release right here. Their revenue increased 8% to $90 billion in just 3 months. Which company can beat Apple on that rate?
No
Another
company
fresh,
right now.
yeah, $90 billion in just 3 months. That's amazing. iPhone revenue is 42.6 compared to 38.8 billion last year. That's just incredible. Like how, there's no peak, I guess, with their customers, despite last year where stimulus checks are being handed out left and right. Now people are complaining of higher prices, no stimulus checks anymore, but still, it's still generating incredible sales numbers. So I guess that's what Wall Street really likes about this company. It's steady growth. It's just unbeatable. Nobody can match this company. Profitability wise, company registered $20.7 billion compared to 20.5 billion last year, which is almost flat, but I mean, it's steady. At least it's not registering losses like Amazon or Meta platforms. Its cash right now, although its cash looks like it suffered quite a dip. 23.6 plus 24.6. 48 billion in cash. Oh no, wait. They still have marketable securities of 120 billion. So they still have plenty of cash in their balance sheet. There's no questioning this company is liquid. Very liquid. That's why Wall Street loves the company. All right, next one. Microsoft. Microsoft took a hit on Tuesday. It went down as much as nearly 8% after it releases earnings report. It's down 3% since the start of the week. So another royal FANG stocks here. It's now $1.76 trillion in company valuation. All right, we got a warning that popped up. We got 10 minutes left, Wowie. So if we're going to take a look at its performance, we're just going to dive in quick. It's been a Tuesday, so you can see its report. So its revenue, it's $50 billion. It's up 10% year on year. So Microsoft is another major company for sure. So I guess they want to, okay, 10Q. This is their quarterly filing. View PDF. So revenue, they added nearly 5 billion more in revenue, and profit, they lost $3 billion, or they reduced their profits by $3 billion almost, from 20 billion to 17.5 billion dollars. Nonetheless, the company is still racking up cash. Total cash is more than $100 billion, while their debt is somewhere around 80 to 90 billion dollars. And you know what? We're gonna try to bring up Google here as well. We almost forgot about Google. Google suffered quite a dip, I think, for the past 5 days.
52-week low.
Yeah, it's down 5% for the week and suffered a big drop, 7% when it released their earnings. So if we're gonna take a look at Google, slump. Here we go. Google. One of our favorite, if not my personal favorite, because of their cash rich status. So Google, third quarter results. Their revenue grew 6% to 69 billion. So they generate more revenue than Microsoft, at least this quarter. But they both miss earnings and revenue expectations.
Yeah.
So their YouTube revenue is down actually 7.07 compared to 7.34 billion the past quarter. Google advertising is 54.48 billion compared to 56 billion in quarter two. So still they generated 4 billion more in revenue. Operating margin have declined, but their profit took quite a hit. It's down 5 billion to 13.9 billion. So a little bit of slowdown here in Google. More likely reflected because of the higher dollar or stronger dollar, and slowdown in advertisement sales for sure. I'm thinking maybe a little bit of crypto impact as well, as a lot less crypto companies are playing their ads on YouTube and stuff. Google Cloud Services still on the red. Other bets lost 1.6 billion in operating losses. So
yeah, I should expect Google and a lot of these FANG stocks to go back up, in my opinion. So,
Yep.
and this is not investment advice, but you're definitely going into that buy region.
For
And
sure. Yeah, they've come a lot. They come down a lot, especially meta platforms. Total cash of Google is nearly 140 billion, more than at least this is more than Microsoft, and they barely have any debt, 15 billion in debt. So this company remains a stalwart. A lot of cash flowing on this company happening. So according to Financial Times, this week has been a brutal week for big tech, with nearly $800 billion wiped off its valuations. So only Apple have been able to recover, or at least a consolation prize for big tech investors. Apple remains steadfast.
Supreme winner.
Yeah.
For this
$90
earnings season.
billion. That's just amazing. Despite all the scare, recession, whatever, they still generate profit. So, on the other hand, the best performing sector and the largest oil company in the world, ExxonMobil, racks up the most lucrative quarter ever. One have said that the company may have been making more money than God. They rack up $20 billion as an oil company in the recent quarter. So this is because of higher oil price and a lot of margins realizing from its petroleum products, not just gasoline, but among others. So its cash, ExxonMobil, actually increased also by 11.6 billion to 30.5 billion dollars, with free cash flow of 22 billion dollars, and its debt to capital is now 19%, just below its low end for its target range. So this company has been exemplary since the start of the year. Let's see its performance for the week. It's up nearly 5%. It's up 74.2% since the start of the year. So despite the upcoming federal rate hike in the next week, we're actually anticipating another support for the market. I think this is in regards to the fund flows as well, Wowie. So I think what's happening now is the smart investors are now putting their money back to work to stocks. This is trying to front run what's about to happen. So this is an important chart from Bloomberg. It says here annual buybacks head for record high. So we're about to see a lot of buybacks coming from these S&P 500 companies. If I'm not mistaken, most of this money that's going to be spent for buybacks are coming from big tech. So they're actually coincidentally will be spending a lot of money, nearly $1.2 trillion anticipated, buying back their own stock. So this could be a perfect time for these big tech companies to take advantage, especially meta platforms. I don't know what's going on with Zuckerberg's head, but in general, this is a good time because a lot of sell-off has taken place, and they'll be buying their own stock at a less pricey range. And one of the Wall Street greats here, like me and Huawei have discussed along the way, Morgan Stanley's Mike Wilson, he's sticking to his bullish call. So this is an article published 4 days ago. He said that the S&P 500 could rally as much as 15% in the near term before again resuming its sell-off. So I don't know, Huawei, what do you think? Too good to be true?
No, it's good right now. So just still be well. I'm still cautious, but I'm not selling. I might do some tax loss harvesting at the end of the year, before the end of the year, and but definitely still heavily invested in technology.
Yeah.
Mhm.
Likewise, yours truly was also invested in the stock market. Regardless, just a disclosure, I think I bought a little bit more of Amazon and bought a little bit more of Meta platforms. I think my losses in Meta platforms is now, I think, more than 50%.
Mhm.
So
For
not a bad, not
yeah.
not a good performance at all. But I'm sticking with it for now. Who knows?
Mhm.
Maybe when Elon Musk buys Facebook or Meta platforms, it'll skyrocket to $500 a share.
Well, that's after servicing $2 billion a year, I think, for Twitter's debt.
Oh yeah, it's gonna be Twitter is at least gonna be packed up with debt because of the recent acquisition by Elon Musk. As you could tell in this background image that we have, Elon Musk inside Twitter's headquarters, bringing a sink with him, saying, "Let that sink in," firing the CEO, CFOs, uh, other top executives along the way. He's gonna try to
Mhm.
build that company into a super app. So it's we're gonna wait to see when that
Well,
happens.
yeah, it's now private, so we'll just have to watch it on the news.
All right. Well, with that, we're gonna end this podcast. Again, this is Mark Yu signing out.
Wabi Santos signing out.